Welcome to the Lighthouse Financial Advisors Money Over 50 podcast with Dallas Davison and Michael Hogue. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Lighthouse Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50. Today's topic, we're going to talk about how to avoid paying 17% inheritance tax. Dallas, your topic.
Thanks, Michael. Thank you. I was pretty happy with this catchy little title, and I think it's a bit of a fear for most people that, everyone always says when they come in to see us, and a big part of our process with people over their last 10 years of their working life is tax planning, tax minimisation, and most people that come to us have the attitude that they've worked hard enough, paid enough tax in their life that if they can minimise tax anywhere possible, then they definitely want to do so. And I think that's another fear, is that if you've built up retirement savings over time, and anything that you haven't spent in retirement that's left over, you want that to go to your kids, and as little as possible you want to go to the ATO. So that's kind of what we're talking about here. So a quick overview. The only thing more boring than talking about superannuation is talking about taxation of superannuation. So I won't go into too much detail, but basically assets held through superannuation or a pension account once you're fully retired are treated a bit differently when you pass away, and depending on who they go to. So if you've got money in a superannuation account and you pass away and it goes to your spouse, who would be considered a dependent beneficiary, they would pay no tax on that. Whereas if it goes to what they call a non-dependent beneficiary, so for example, adult children who are off your hands and you're not funding their life, they would be considered a non-dependent beneficiary. There's a 17% tax payable on the taxable portion of your superannuation fund. And so,
which is a very confusing term there, but let's just assume for the moment that the majority of most people's superannuation fund is made up of what they call a taxable taxed proportion.
We won't even get into taxable tax, taxable untaxed.
But basically, which effectively means
so the money that has gone in at a reduced tax rate. So your employer contributions is a big one. So yes. I'll use a case study for this to make it a sort of a more concrete example. Most people who come to us are about age 55 and have about $500,000 in super, and that's generally been made up of their employer contributions over their working life. So those employer contributions go in. There's a 15% contributions tax that's levied on them on the way in, which most people sort of aren't aware of, but that's all. And so it's basically that's considered a taxable component. So like you said, for most people coming in to see us, that is a significant portion of their balance is caught under these rules. So again, continuing that example, if a couple comes in to see us with $500,000 in super, and I'll just keep it very simple here and say that all the superannuation is in one of their names. So in this case, the husband's been working for 35 years and he's got a superannuation balance of $500,000, and his wife has been having kids, raising the kids, doing all that sort of thing. Now, over the last 10 years of their working life, what we are always focused on is these people would probably be on track to grow their superannuation from $500,000 to $1 million, and our job is to try and add an extra 500,000. So to take that from 500,000 up to 1.5 million, which is on average what people kind of need when they retire. So let's assume that we've done our fantastic work and these clients have done the hard yards and they've got from 500,000 up to 1.5 million, and that's all been made up of before tax contributions. So what we have at that point in time is retirement savings of $1.5 million that are all, it's all inside superannuation, it all moved across into a pension account, but it's all taxable money. Now, and this is kind of how I'll talk a bit more about how we could change things a bit, but in the worst case, what happens is that $1.5 million, assuming that they spend the return on that, it just ticks along sideways. the husband passes away, it transfers across into the wife's name. She pays no tax on that transfer because she's a dependent beneficiary. If 5 years later she passed away and that money goes to their adult children, if all of that money is taxable, they would have to pay a 17% tax on that withdrawal at that point in time.
Yeah, so on inheritance of the $1.5 million in this example, and we're assuming down the road a little bit, but it doesn't have to be. But you know, it might be 20 years into their retirement. The death of the second spouse could be later than that. Then the adult children who are by that stage in their 50s probably, who are, let's assume, all non-financially dependent. They would actually have to have some sort of intellectual disability generally to be classed as a financial dependent. So they would pay tax of 17% on that money generally. Now, just to clear up, certainly, because when you first breach this with people, they say, "Oh, why would I have my money in superannuation?" Superannuation and account-based pension in particular is just the most tax-effective place to own your money while you're alive. So owning your money in that environment for most people would mean that they have easily more than 17% higher balance upon their death, easily, if not 40 to 50% higher balance, as opposed to cashing their money out of superannuation.
That's right.
And just having it in a bank account or invested in their own name. So it is the right environment for people to keep. What we're talking about here is just some estate planning.
And that's a good point,
minimise that.
Because I think that's a part of, with all of our tax minimisation strategies, you really need to look at the big picture. So it's no good saving tax in 1 year or in one, saving tax in one area if you're just paying more in another area. So what you really want to do is save as much tax as possible on the income that you earn in your working life, and save as much tax as possible on the return of your retirement savings, and then on the income that you're drawing in retirement, and also save as much tax as possible when any money goes to your kids. So it's a matter of getting all that working in together. And so you're dead right, where over the last 10 years of someone's working life, that's a big part of their strategy, is minimising that income tax and the tax on the earnings of that, and superannuation, and then moving that across into a pension account is really the holy grail of where you want your retirement savings, because that's, like we said, is a huge amount of tax savings that get built up over time within there. And so now what we're really talking about is out the other end of this, the end game of this situation of how do we then have as much of that money that we've built up by saving all that tax on the way through, how do we have that go through to our kids tax-free? So, but yeah, that's I guess the big one is if you think about that, from even if the $1.5 million just goes sideways and they pass away and that goes to their kids, that's a $250,000 tax bill going to the ATO on that whole amount, which is pretty scary. For most people, don't like paying $10,000 tax a year. You definitely don't want to be paying $250,000 when you pass away.
So take us through an example of how you, what's a strategy where you can minimise that?
So there's a couple of different ones. The very simple one, as you've alluded to earlier this morning, we were talking about this. The simple one is if you know that you're going to pass away and you are the remaining spouse, and you diagnosed with a terminal illness, you've got 6 months to live. All you do is you take your $1.5 million out of superannuation, out of a pension environment, and just leave it in your bank account.
Yeah, which can be done tax-free whilst you're alive.
Exactly right. Yeah. So in most cases though, we don't know when that's going to happen.
No, it's one of those ones it's impossible to plan for if you drop dead overnight. If you're diagnosed with a terminal illness, you have time to plan. So we have a process, an internal process here with our clients where if there's only one remaining spouse, or if we have a person that's single in their retirement, we take them through an estate planning discussion where we basically ask them to say to let us know if they're ever diagnosed with something that is a terminal illness or may become a terminal illness.
That's right. Yeah.
So we can plan for these things. So I mean the really basic analogy here is that with one spouse remaining,
Yeah.
if that person was to pass away and their money's still in superannuation,
Yeah.
in this example,
Yeah.
their children,
Yeah.
assuming the children
Yeah.
are non-dependent beneficiaries, would pay 17% tax
Yeah.
on that $1.5 million.
Yeah.
If that person was to be diagnosed with a terminal illness,
Yep.
and
Take all
say
that
to
money.
it, basically they could withdraw that $1.5 million while they're still alive,
Yeah. Tax free.
tax-free, pop it in the bank or even invest it in their own name.
Yep.
Effectively, they pass away,
Yep.
a day later, a week later, a month later.
Yeah.
Then that money that's in the bank account now
Yep.
can be distributed to the non-dependent beneficiary children tax-free.
Yep. So that's I guess the easy one, and it's kind of, it's a bit like with people when they say about if they want to spend more money in retirement, they want to run out of money in retirement. We can do that as well, as long as you know when you're going to pass away. But
Yeah.
the reality is, for most people, you don't know when that's going to happen.
No, that's right.
And everyone says the dream is to die peacefully in your bed and not know that it's coming, sort of thing. So the second way to minimise that, the effect of that, and it's something that we look at while you're still working, is what they call a recontribution strategy. And so it's a bit trickier for some people, but in simple terms, once you're age 60 and over, you can draw money out of superannuation or a pension account completely tax-free. So to keep it very simple here, if we were to say that this person in the last 5 years of their working life, so they're 55 now, from 60 to age 65, in that last 5 years, they take $100,000 out of their superannuation account and recontribute it back in as an after-tax contribution. So over that last 5 years, they've got that $500,000 of that 5 lots of 100. So what they've effectively done there is that they've changed the components of their superannuation from being $1.5 million of taxable money to only $1 million of taxable money and $500,000 of tax-free money.
Yes.
So even if that's all they could do, that would obviously make a big difference. Is that, again, assuming everything happens the whole way through, when they pass away, that money goes to their spouse tax-free. Then when the spouse passes away, instead of their adult children paying 17% on the whole 1.5, they're only paying 17% on the $1 million of taxable component left over.
So it's an internal shifting of the behind-the-scenes components, which are the two main common components are called tax-free and taxable tax, which is it's always a strange name. Must confuse the hell out of people. Taxable tax as a component.
And it's always this is such a whenever I go through this strategy, because I really like doing the strategy with people, and you end up drawing bits and pieces on a piece of paper of circles here and lines here, and it's sort of hard to explain that you move the money out, you move it back in.
Yes.
And it seems bizarre to think about the concept that if you do that over time, that will make a huge difference.
Yeah, that's right.
And that's kind of where, even over that last 5 years of your working life, moving 500,000 of that across into a from taxable to tax-free, that's going to save $85,000 in inheritance tax in the event of their death. Now, where it gets even better is if you can do more than sort of that 5 years. If over time you can, after age 65, you're still working part-time, for example, from age 65 onwards, if you can still contribute into money into superannuation, you have to meet what they call a work test, but I won't even get into that. But if you can just keep doing that every year from age 60 up to age 75, you could conceivably over that time wash all of that money from being taxable. You pull $100,000 out each year, you put it in, it becomes tax-free. So if you were working part-time in semi-retirement from 65 onwards, you could conceivably change that full $1.5 million across from taxable into tax-free. And that's again the dream there. That's what you'd want to try and achieve.
And look, it's a just a bit of a warning. It's a detailed strategy. So one of the things, if you attempt to do this prior to turning age 60, just be warned, you could get a nasty surprise of them taxing you.
Yep.
So
Yep.
tax is payable
Yep.
on super redemptions or
Yep.
account-based pension
Yep.
payments.
Yep.
Would be transitioned to reretirement pension payments prior to age 60. So
it's
turning age 60 is important.
Yeah.
And there's a few other. I guess
so many
there's a lot of moving
parts.
parts to this strategy. Yeah. So look, we're just to be clear.
Yeah.
Anyone that's listening,
Don't jump in. Don't try this at home.
we are not providing advice here. We're providing some information here.
You're such a lawyer, mate.
Well, I mean, it is a very, very detailed strategy. You've got to get all your ducks in a row.
Yeah.
And you make one misstep.
Yeah. And as we said, if you do something wrong and you pay tax on the way through, it really dampens the effect of I'll save inheritance tax, but I'll have to pay more income tax or tax on a super withdrawal or something like that. So I guess you're right. So the big things that I'd think about here, or the point that I really wanted to make today, is not to say you should jump out there and check how much, what component of your supers, what's taxable, what's tax free. Can you do this? Can you set up a pension account? Yes, all those sorts of things. As you said, it's a very technical area, but the big things I think to think about is to be aware of is that there is potentially inheritance tax payable when you pass away if that money goes to your kids. So that's, for most people, they're not aware of that as an actual thing that can happen. And the second part is that there are things that you can do to plan around that and to minimise the effect of that. So as always, we don't want to just come to you and say, here's the problem. The second part of it is with some good planning work early on and during your working life, we can really minimise the effect of that.
Yeah, absolutely. And look, it's also for people that are listening in their mid-50s to mid-60s, a lot of those people, most of those people, their parents are still alive, or the second member of their parents are still alive.
Yep.
And whilst it's uncommon for people that are in their 80s and 90s right now to have large superannuation balances.
Yeah.
It does exist.
Yes.
So this could be something that you have the discussion with your parents who have money in superannuation and make them aware of that.
Yeah.
That hey, if you don't get your ducks in a row, then and to be fair, most of those people as well wouldn't want
that to happen.
17%.
Yeah.
Of their, it's almost it's nearly 1/5 of their retirement savings being potentially lost in tax.
Yeah. So I think as per usual here, we've talked about something for 20 minutes and we haven't actually given any concrete action steps other than to be aware.
I think awareness is the main thing for people. So be aware that is, and then seek specific advice off the back of that, because it is difficult to do on your own. If you make a wrong step or miss a step or get a step too early, then the potential savings are unwound with the tax that you pay then and there.
And I think that's a good point for someone who's 55 now and has a surviving parent who's 85. It's definitely worth looking at in that case as well, because I always joke about this with the 55-year-olds that I'm helping with these sorts of strategies now, and I think these people are doing all this great work, and I'm helping them do all this great work to minimise all this inheritance tax. They're never going to see the benefits of that. It's all going to go to their kids. So
that's right.
If you can look at your actual parent situation and minimise that, then at least there's sort of something in it for you in that case.
Yeah, absolutely. So, look, I think we've spoken enough today because it's it's a really, really hard one to walk through.
Yes.
Over audio.
Yeah.
Is that the right term?
I think that's right. As I say, normally
over a podcast.
Normally when I talk about this, I end up with circles here and lines here.
It's a visual thing.
And specific numbers for people. But as I said, those are the two big takeaways that I would say with this is that, number one, an inheritance tax, it's not just something that governments roll out as a thing to try and scare people about their opposition. An inheritance tax is a real thing in Australia with regards to your superannuation. And the second part of it is that there are things that you can do to minimise the effect of that.
Yep. Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Lighthouse Financial Advisors. We look forward to catching up again soon.